Question 1. Concept-based. In a liability insurance policy, which of the following best describes the principle of indemnity? A. It requires the insured to be compensated for their losses without the possibility of profit. B. It allows the insured to recover more than the actual loss depending on the policy limits. C. It requires the insurer to pay for any damage to the insured's property regardless of negligence. D. It limits the insurer's liability to specific perils mentioned in the policy. Answer A. It requires the insured to be compensated for their losses without the possibility of profit. Explanation. The principle of indemnity and insurance aims to restore the insured to their financial position prior to the loss without allowing them to profit from the claim. This ensures that the insured cannot recover more than the actual amount of the loss. The options regarding recovering more than the actual loss or paying regardless of negligence, B and C, misrepresent the concept of indemnity, while D refers more to policy exclusions rather than indemnity itself. Relevant rule. Indemnity is a fundamental principle in insurance designed to prevent the insured from profiting from a claim. Alaska's Department of Insurance mandates that insurance contracts adhere to the principle of indemnity, ensuring fair compensation for losses. Question 2. Scenario-based. Mr. Davis owns a small fishing charter business in Alaska. One day, while transporting a group of tourists, his boat hits a submerged rock, causing damage to the boat and injury to one of the passengers. Mr. Davis is covered under Commercial General Liability (CGL) policy, which coverage under his CGL policy is most likely to respond to the injured passenger's claim for medical expenses. A. Coverage A. Bodily injury and property damage liability. B. Coverage B. Personal and advertising injury liability. C. Coverage C. Medical payments. D. Pollution liability exclusion. Answer. C. Coverage C. Medical payments. Explanation. Coverage C of a Commercial General Liability (CGL) policy provides medical payments coverage for injuries that occur on the insured's premises or as a result of the insured's operations, regardless of fault. In this case, the injured passenger's medical expenses would most likely be covered under Coverage C as it offers no-fault medical payments up to a limit. Coverage A would apply to liability claims for negligence, but Coverage C is more immediate for medical expenses. Coverage B relates to personal injury and advertising injury, which are not relevant here, and the pollution liability exclusion D does not apply to this situation. Relevant rule. Alaska's insurance regulations require CGL policies to include medical payments coverage, Coverage C, to handle small claims efficiently and avoid litigation over minor injuries. Question 3. Concept-based. Which of the following defenses is commonly used in liability claims to reduce the plaintiff's recovery by determining the percentage of fault attributable to both the plaintiff and defendant? A. Assumption of risk. B. Statute of limitations. C. Contributory negligence. D. Comparative negligence. Answer. D. Comparative negligence. Explanation. Comparative negligence is a legal defense in liability claims that reduces the plaintiff's recovery based on their own percentage of fault. For example, if the plaintiff is found to be 30% at fault for the incident, their recovery is reduced by that amount. This contrasts with contributory negligence, C, where even a small degree of fault by the plaintiff can bar them from recovery altogether. Assumption of risk is a defense where the plaintiff knowingly assumes the risk of the activity, and the statute of limitations B limits the time within which a claim can be filed. A relevant rule. Alaska follows a modified comparative negligence rule, which allows plaintiffs to recover damages as long as they are less than 50% at fault. If the plaintiff's fault exceeds this threshold, they are barred from recovery. Question 4. Concept-based. Which of the following best describes insurable interest in the context of property insurance? A. The insured's financial stake in the property at the time of loss. B. The value of the property that is covered under the insurance policy. C. The relationship between the insured and the insurance company. D. The potential for profit from the insurance policy. Answer A. The insured's financial stake in the property at the time of loss. Explanation. Insurable interest refers to the requirement that the insured must have a legitimate financial interest in the property being insured at the time of the insurance contract and at the time of loss. This means the insured would suffer financial loss if the property were damaged or destroyed. Options B and D misrepresent the concept, while C describes the contractual relationship rather than the insurable interest itself. Relevant rule. Under Alaska insurance law, insurable interest is a fundamental requirement in property insurance contracts, ensuring that individuals do not take out insurance policies on property they have no legitimate stake in. Question 5. Scenario-based. Mrs. Lopez owns a bakery and has purchased a business owner's policy BOP to protect her business. A fire breaks out due to faulty wiring, resulting in significant damage to the bakery, equipment and inventory. Which of the following coverages in her BOP will most likely cover the damage to her equipment? A. Liability coverage. B. Property coverage. C. Business interruption coverage. D. Medical payments coverage. Answer: B. Property coverage. Explanation: property coverage in a business owner's policy BOP is designed to protect the insured's property against risks such as fire, theft, and vandalism. In this scenario, the fire damaging Mrs. Lopez's bakery equipment would be covered under the property coverage part of her BOP. Liability coverage: A is for third-party claims. Business interruption coverage. C compensates for lost income due to a covered loss, and medical payments coverage. D relates to injuries to others on the premises, which is not applicable here. Relevant rule: Alaska insurance regulations require BOPs to provide adequate property coverage to protect business assets from unforeseen events such as fires. Question 6. Concept-based. In a claims-made policy, which of the following statements is true regarding coverage? A. Coverage is triggered by the occurrence of the event during the policy period. B. Coverage is triggered by the reporting of the claim within the policy period, regardless of when the event occurred. C. Claims must be made to the insurer within 30 days of the event to be covered. D. The policy does not cover claims made after the policy has expired, regardless of when the event occurred. Answer: B. Coverage is triggered by the reporting of the claim within the policy period, regardless of when the event occurred. Explanation: in a claims-made policy, coverage is triggered by the reporting of the claim during the policy period, even if the event causing the claim occurred before the policy was in force. This is different from occurrence policies, which cover claims based on when the event occurred. The statement regarding claims being made within 30 days C is inaccurate, as there is no such requirement for claims-made policies. Coverage is indeed not available after expiration if the claim is reported after the policy ends. D, but it can be reported if it occurred during the coverage period. Relevant rule: Alaska insurance regulations stipulate that claims-made policies must clearly state their coverage triggers and limitations to ensure that insured parties understand their responsibilities in reporting claims. Question 7. Concept-based. What is the primary purpose of a waiver and estoppel in insurance contracts? A. To prevent the insurer from denying a claim based on policy exclusions. B. To enforce a contract even if one party fails to fulfill its obligations. C. To allow the insured to recover damages even if they did not meet policy conditions. D. To establish that certain rights under the policy have been relinquished by the insurer. Answer: D. To establish that certain rights under the policy have been relinquished by the insurer. Explanation: waiver and estoppel in insurance refer to the principle that an insurer can relinquish its rights under the policy through its conduct. For instance, if an insurer accepts premium payments after knowing of a potential claim, they may be deemed to have waived their right to deny coverage based on that claim. Options A, B, and C do not accurately reflect the legal implications of waiver and estoppel, as they relate to rights and obligations rather than merely denying claims or enforcing contracts. Relevant rule: under Alaska insurance law, waiver and estoppel can play significant roles in claims handling, particularly when determining whether an insurer can assert defenses against a claim based on their previous actions. Question 8. Concept-based. Which of the following statements regarding the assumption of risk is correct? A. It automatically absolves the defendant of liability in all situations. B. It applies only in cases of negligence, not intentional acts. C. It can be implied through the behavior of the plaintiff in risky situations. D. It allows the plaintiff to recover damages despite having assumed the risk. Answer: C. It can be implied through the behavior of the plaintiff in risky situations. Explanation: assumption of risk is a defense used in liability claims where the plaintiff is considered to have accepted the risks associated with a particular activity. This can be implied through the plaintiff's behavior or participation in activities that are inherently risky. It does not automatically absolve the defendant of liability in all cases, nor does it apply exclusively to negligence. B. Option D is incorrect, as assuming risk typically limits the plaintiff's ability to recover damages. Relevant rule: in Alaska, the doctrine of assumption of risk can affect the outcome of liability cases, particularly in activities involving inherent risks, and it is an essential consideration in tort law. Question 9. Concept-based. Which of the following best describes statute of limitations in the context of liability claims? A. It determines the maximum time period allowed for parties to initiate a lawsuit after an event. B. It sets the minimum amount of damages that can be recovered in a lawsuit. C. It allows claims to be filed indefinitely after an event, provided there is valid evidence. D. It applies only to claims involving bodily injury and not property damage. Answer A. It determines the maximum time period allowed for parties to initiate a lawsuit after an event. Explanation. The statute of limitations establishes the time frame within which a claimant must file a lawsuit after an incident occurs. If a claim is not initiated within this period, it may be barred. This concept does not relate to the minimum damages that can be recovered. B. Nor does it allow for indefinite claims. C. Or apply exclusively to bodily injury. D. Different statutes of limitations apply based on the type of claim. Relevant rule. In Alaska, the statute of limitations for personal injury claims is typically 2 years, while property damage claims may have a different duration. Understanding these time limits is crucial for anyone involved in liability claims. Question 10. Concept-based. In the context of workers' compensation, which of the following statements is true regarding employer liability? A. Employers are not liable for injuries that occur on the job if the employee was negligent. B. Employers have unlimited liability for all employee injuries, regardless of circumstances. C. Workers' compensation provides the exclusive remedy for employees injured on the job. D. Employers can opt out of providing workers' compensation insurance at any time. Answer. C. Workers' compensation provides the exclusive remedy for employees injured on the job. Explanation. Workers' compensation laws provide that employees cannot sue their employers for work-related injuries. Instead, they must seek compensation through the workers' compensation system. This system is designed to provide benefits regardless of fault, making it the exclusive remedy. C. Employers are not completely shielded from liability if certain exceptions apply. A. And they do not have unlimited liability. B. As there are caps and specific benefits outlined, employers are typically required to provide coverage and cannot opt out unless they meet specific legal criteria. D. Relevant rule. Alaska's Workers' Compensation Act mandates that employers must carry workers' compensation insurance to protect employees and outline their rights and benefits in case of work-related injuries. Question 11. Concept-based. What is the primary purpose of a certificate of insurance? A. To provide proof of insurance coverage to third parties. B. To serve as a permanent insurance policy document. C. To summarize the policy limits and coverage types for the insured. D. To replace the need for an insurance policy altogether. Answer A. To provide proof of insurance coverage to third parties. Explanation. A certificate of insurance is a document issued by an insurer or broker that provides proof of insurance coverage to a third party, often required in business contracts or for leasing agreements. It does not serve as a permanent policy document. B. And does not summarize policy limits for the insured. C. Instead, it acts as a temporary acknowledgement of coverage. It does not replace an insurance policy. D. As it is simply a verification of existing coverage. Relevant rule. Under Alaska insurance regulations, certificates of insurance must accurately represent the coverage and limits provided in the underlying insurance policy. Question 12. Scenario-based. Mr. Smith is a contractor who has purchased a general liability insurance policy. During a construction project, one of his workers accidentally damages a neighboring property. Which coverage in Mr. Smith's policy would most likely respond to this situation? A. Professional liability coverage. B. Product liability coverage. C. Premises liability coverage. D. Completed operations coverage. Answer. C. Premises liability coverage. Explanation. Premises liability coverage in a general liability insurance policy provides protection for damages or injuries that occur on the insured's premises or due to the insured's operations, including damage to neighboring properties. Professional liability. A. Covers errors in professional services. Product liability. B. Pertains to damages caused by products sold and completed operations coverage. D. Addresses liabilities arising after the completion of work, which may not apply to ongoing construction. Relevant rule. Alaska's insurance regulations require general liability policies to cover liabilities arising from property damage due to the insured's operations, ensuring adequate protection for contractors. Question 13. Concept-based. Which of the following best describes subrogation in the context of insurance? A. The process by which an insured receives benefits from their own insurer. B. The right of an insurer to recover costs from a third party responsible for a loss. C. The assignment of policy benefits to a third party. D. The cancellation of an insurance policy by the insurer. Answer. B. The right of an insurer to recover costs from a third party responsible for a loss. Explanation. Subrogation is the legal right of an insurer to pursue a third party that caused an insurance loss to the insured, allowing the insurer to recover costs they have paid out in claims. It does not refer to the insured receiving benefits A, or assigning benefits C, nor does it involve the cancellation of a policy D. Relevant rule. Under Alaska law, subrogation rights are typically included in most insurance contracts, allowing insurers to recover losses and ultimately help keep premiums in check. Question 14. Concept-based. What is the additional insured status in an insurance policy? A. A coverage extension for the primary insured's family members. B. A provision that adds another party to the policy's coverage. C. A requirement for all policyholders to include third parties. D. A feature that limits coverage to only the primary insured. Answer. B. A provision that adds another party to the policy's coverage. Explanation. The additional insured status allows a third party, often a contractor or client, to be included in the coverage of the primary insured's policy. This means they receive protection under the same terms and conditions as the primary insured. This is not a coverage extension for family members A, nor is it a requirement for all policyholders C. It does not limit coverage to the primary insured D. Relevant rule. Alaska insurance laws recognize the importance of additional insured endorsements, particularly in contractual agreements, to ensure adequate protection for all parties involved. Question 15. Scenario-based. A retailer in Alaska is experiencing frequent thefts. To mitigate this risk, they decide to purchase a crime insurance policy. Which type of coverage would most likely be included in this policy? A. Workers' compensation coverage. B. Business interruption coverage. C. Employee dishonesty coverage. D. Property damage coverage. Answer. C. Employee dishonesty coverage. Explanation. Crime insurance policies typically include coverage for losses due to employee dishonesty, which protects the retailer against theft or fraud committed by employees. Workers' compensation is unrelated to theft. Business interruption coverage. B. Addresses lost income due to events that disrupt operations. And property damage coverage. D. Focuses on physical damage rather than theft. Relevant rule. Alaska law allows businesses to purchase crime insurance as a necessary risk management tool to protect against losses from theft and fraud. Question 16. Concept-based. Which of the following statements accurately reflects the principle of indemnity in insurance? A. The insured can profit from an insurance claim. B. The purpose of insurance is to restore the insured to their pre-loss condition. C. Indemnity applies only to liability insurance policies. D. Insurers are obligated to pay more than the actual loss incurred. Answer. B. The purpose of insurance is to restore the insured to their pre-loss condition. Explanation. The principle of indemnity ensures that insurance is designed to restore the insured to their original financial position prior to a loss, rather than allowing them to profit from it. A. Indemnity applies to all types of insurance, not just liability. C. And insurers are not obligated to pay more than the actual loss. D. As that would violate the indemnity principle. Relevant rule. Alaska's insurance regulations reinforce the concept of indemnity, ensuring that insured parties receive fair compensation for losses without profit. Question 17. Concept-based. In the context of liability coverage, what does the term duty to defend refer to? A. The insurer's obligation to cover settlement costs. B. The insurer's responsibility to provide a legal defense against claims. C. The insured's responsibility to present their case. D. The limitation of coverage to only damages awarded by the court. Answer. B. The insurer's responsibility to provide a legal defense against claims. Explanation. The duty to defend is a fundamental aspect of liability insurance, whereby the insurer is required to provide legal defense for the insured against claims, regardless of the outcome. This obligation is broader than just covering settlement costs, A, as it also encompasses the costs of legal defense itself. It does not shift the responsibility to the insured, C, or limit coverage to court-awarded damages, D. A relevant rule. Alaska law mandates that liability insurers fulfill their duty to defend insured parties against covered claims, reflecting the protective intent of liability coverage. Question 18. Concept-based. What is a loss of use coverage in a property insurance policy? A. Coverage for damages to personal property. B. Compensation for loss of rental income due to property damage. C. Reimbursement for legal expenses incurred from property claims. D. A provision that allows property owners to sue for damages. Answer. B. Compensation for loss of rental income due to property damage. Explanation: loss of use coverage compensates the insured for lost income from rental properties or business operations due to damage that makes the property uninhabitable or unusable. It does not cover damages to personal property. A. Legal expenses. C. Or allow for lawsuits. D. Relevant rule: under Alaska insurance regulations, loss of use coverage is often included in property insurance policies to ensure that property owners are compensated for income losses resulting from covered perils. Question 19. Concept-based. Which of the following statements is true regarding exclusions in insurance policies? A. Exclusions limit the coverage provided by the policy. B. Exclusions apply only to liability insurance. C. All insurance policies must have the same exclusions. D. Exclusions are irrelevant to the determination of a claim. Answer A. Exclusions limit the coverage provided by the policy. Explanation: exclusions are specific conditions or circumstances that are not covered by the insurance policy, effectively limiting the insurer's liability. They are not limited to liability insurance. B. And can vary widely between policies. C. Exclusions are crucial to determining whether a claim is covered. D. As they directly affect the insurer's obligations. Relevant rule: Alaska insurance laws require that exclusions be clearly stated in policies to ensure that insured parties understand the limitations of their coverage. Question 20. Concept-based. Which of the following is a primary purpose of the National Association of Insurance Commissioners, NAIC? A. To enforce insurance laws at the federal level. B. To provide a forum for state insurance regulators to coordinate and share information. C. To set premium rates for all insurance policies. D. To issue insurance licenses to agents and brokers. Answer: B. To provide a forum for state insurance regulators to coordinate and share information. Explanation: the NAIC is a collective organization of state insurance regulators that provides a platform for discussing and coordinating regulatory practices, sharing information, and developing model laws and regulations. It does not enforce insurance laws at the federal level. A. Set premium rates. C. Or issue licenses. D. Which are typically responsibilities managed at the state level. Relevant rule: the NAIC facilitates collaboration among state regulators, promoting effective regulation of the insurance industry and ensuring that state laws align with industry standards and practices. Question 21. Concept-based. What is the primary objective of risk management in the insurance context? A. To eliminate all potential risks associated with insurance policies. B. To assess and minimize the financial impact of potential risks on the insurer. C. To ensure compliance with all regulatory requirements. D. To maximize profitability through aggressive underwriting practices. Answer: B. To assess and minimize the financial impact of potential risks on the insurer. Explanation: risk management involves identifying, evaluating, and prioritizing risks, followed by coordinated efforts to minimize, monitor, and control the probability or impact of unforeseen events. Its goal is not to eliminate risks entirely, but to mitigate their financial consequences. Compliance with regulations. C. And profitability through aggressive practices. D. Are considerations but do not capture the primary objective of risk management. Relevant rule: effective risk management aligns with the principles of underwriting and loss control, allowing insurers to maintain financial stability and solvency. Question 22. Concept-based. Which principle of insurance is violated when an insurer fails to pay a valid claim without a legitimate reason? A. Utmost good faith. B. Insurable interest. C. Indemnity. D. Subrogation. Answer A. Utmost good faith. Explanation: the principle of utmost good faith, ubirmi fide, mandates that both parties, the insurer and the insured, act honestly and disclose all relevant information. If an insurer unjustly denies a valid claim, it violates this principle by failing to act in good faith. Insurable interest. B. Relates to the insured's financial stake in the insured item. Indemnity. C. Refers to compensating the insured for their loss. And subrogation. D. Allows insurers to pursue recovery from third parties after paying a claim. Relevant rule: state insurance laws typically reinforce the necessity of utmost good faith in contractual relationships between insurers and policyholders. Question 23. Scenario-based. Mr. Thompson owns a small grocery store and has a business owner's policy BOP. After severe storm damages his building and inventory, he files a claim. The insurer denies the claim, citing water damage as an exclusion. What should Mr. Thompson do next? A. Accept the denial and seek alternative coverage for future losses. B. Consult the policy's terms to verify if water damage is indeed excluded and consider appealing the decision. C. File a complaint with the local regulatory authority against the insurer. D. Immediately seek legal action against the insurer for the denied claim. Answer: B. Consult the policy's terms to verify if water damage is indeed excluded and consider appealing the decision. Explanation: before taking any further action, Mr. Thompson should carefully review his BOP to understand the specific terms and exclusions regarding water damage. If he believes the denial is unjustified, he can appeal the decision based on the policy provisions. Accepting the denial without further inquiry may lead to unnecessary losses. Filing a complaint. C is a step that may follow an appeal, and seeking legal action. D should be a last resort after exploring policy remedies. A relevant rule: insurance policies typically contain specific definitions of covered perils and exclusions. Understanding these is crucial for navigating claims. Question 24. Concept-based. In the context of liability insurance, what does a vicarious liability refer to? A. The liability of an individual for their own negligent actions. B. The responsibility of a third party for the actions of another party. C. The allocation of liability based on shared fault between two parties. D. The liability incurred when an insured party engages in illegal activities. Answer: B. The responsibility of a third party for the actions of another party. Explanation: vicarious liability holds one party legally responsible for the negligent actions of another, typically in an employer-employee relationship. For instance, an employer may be liable for acts committed by an employee while performing job duties. Option A describes direct liability, C pertains to comparative negligence, and D involves specific legal consequences unrelated to the concept of vicarious liability. Relevant rule: vicarious liability principles are often established in tort law and are applicable in various liability insurance coverages. Question 25. Concept-based. What does the term aggregate limit refer to in a liability insurance policy? A. The maximum amount the insurer will pay for any single claim. B. The total amount the insurer will pay for all claims during a policy period. C. The limit on how much coverage is available for personal injuries only. D. The maximum amount of premium the insured can be charged. Answer: B. The total amount the insurer will pay for all claims during a policy period. Explanation: an aggregate limit is the maximum amount an insurer will pay for all covered losses during a specified policy period, regardless of the number of claims filed. The individual claim limit refers to the limit per incident, while option C is inaccurate as aggregate limits apply to all claims, not just personal injuries. Option D incorrectly describes premium limitations. Relevant rule: aggregate limits are critical in policy structuring and help insurers manage risk exposure over time. Question 26. Concept-based. Which of the following is a key characteristic of a claims-made insurance policy? A. Coverage is triggered by the occurrence of an event during the policy period. B. Coverage is provided only if a claim is made during the policy period. C. Coverage remains in effect indefinitely after the policy is cancelled. D. Coverage applies exclusively to bodily injury claims. Answer: B. Coverage is provided only if a claim is made during the policy period. Explanation: in a claims-made policy, coverage is triggered when a claim is reported, not when the incident occurs. This is different from occurrence policies, where the event must take place during the policy period. Claims-made policies do not continue indefinitely at C and are not exclusive to bodily injury claims. D. They can cover various types of liability. Relevant rule: understanding the implications of claims-made versus occurrence policies is essential for ensuring adequate coverage and compliance with professional liability requirements. Question 27. Concept-based. Under the principle of indemnity, which of the following best describes its purpose? A. To provide profit to the insured after loss. B. To ensure that the insured is restored to their financial position prior to the loss. C. To limit the insurer's financial exposure. D. To encourage the insured to take greater risks. Answer: B. To ensure that the insured is restored to their financial position prior to the loss. Explanation: the principle of indemnity states that an insured party should not profit from an insurance claim but should be restored to the financial condition they were in before the loss occurred. This principle prevents moral hazard. D. Does not inherently limit the insurer's exposure. C. And explicitly does not aim to provide profit to the insured. Relevant rule: indemnity is a foundational concept in insurance that underpins most property and liability insurance contracts. Question 20. Concept-based. What is the primary function of a surety bond? A. To provide insurance coverage for physical damages. B. To guarantee that a principal will fulfill their contractual obligations. C. To protect against liability claims. D. To reimburse an insurer for losses incurred. Answer: B. To guarantee that a principal will fulfill their contractual obligations. Explanation: a surety bond serves as a guarantee that a principal will perform their contractual duties. If they fail to do so, the surety bond issuer compensates the obligee bond beneficiary up to the bond amount. Surety bonds are not designed for physical damage coverage or liability protection. C. Nor do they typically involve reimbursement scenarios. D. Relevant rule: surety bonds are governed by specific contractual agreements and state laws, ensuring compliance with regulatory and industry standards. Question 29. Concept-based. What does a subrogation allow an insurer to do after paying a claim? A. It allows the insurer to increase the premium for the insured. B. It allows the insurer to pursue recovery from a third party responsible for the loss. C. It allows the insured to claim additional benefits. D. It allows the insurer to cancel the policy without notice. Answer: B. It allows the insurer to pursue recovery from a third party responsible for the loss. Explanation: subrogation is the legal process through which an insurer, after paying a claim, can seek reimbursement from a third party who caused the loss. This does not affect premium rates. A. Does not grant the insured additional benefits. C. And does not give the insurer the right to cancel a policy. D. Based on subrogation rights. Relevant rule: subrogation is a critical aspect of risk management for insurers and is often included as a provision in insurance policies. Question 30. Concept-based. Which of the following describes a comparative negligence? A. A complete defense against liability claims. B. A legal doctrine that allows damages to be reduced based on the degree of fault of the claimant. C. A requirement that all parties share equal liability for damages. D. A method for insurers to calculate premiums based on risk. Answer: B. A legal doctrine that allows damages to be reduced based on the degree of fault of the claimant. Explanation: comparative negligence is a legal doctrine used in tort law to determine the extent to which a claimant's own negligence contributed to their injury. Under this principle, damages awarded to the claimant are reduced in proportion to their degree of fault. Option A refers to contributory negligence, which can completely bar recovery, while C does not accurately reflect how liability is apportioned. Option D relates to underwriting practices rather than liability determinations. A relevant rule: comparative negligence is applied in many jurisdictions, impacting how damages are awarded in liability claims.